David Kudla is the founder, CEO, and chief investment strategist at Mainstay Capital Management. And David, the S&P at a record high right now. Any gain today is actually a record high because we closed at an all-time high yesterday. You call this a melt up in equities. How has the narrative changed in the stock market over the last couple of days?
Yeah, it last couple of days or last 11 days, right? It's really amazing. It wasn't a change in fundamentals. It was an external force putting pressure on stocks, taking stocks down, depending on the index, 7, 8, 9% with the conflict in Iran. And I think really it's after the talks and some recent events, we've seen the Strait of Hormuz, everything has changed there. It almost seemed like overnight last week, but it seems like everything has changed in a way that now what's causing this melt up is we have the hedge funds are caught short. They're at their shortest position in a long time. Fund managers were the most bearish since June of 25. And the CTAs had rotated and were selling instead of buying. Now all those forces are coming back in and have to. We've got essentially a short squeeze that's driven the market higher and continues into today. So it's just been, there's all kinds of statistics out there on this V-shaped recovery, the fastest, in decades and terms of the ascent up. So it really is a melt-up-like behavior these last 11 days.
CTAs, can you explain what CTAs are and kind of how they're impacting the market? Because this is something new for a lot of investors.
Yeah, it's really about momentum, trend followers. And so the way that they get caught, depending on the frequency of moves in the market, or like this, where the market had been suffering for over a month. So they start to rotate towards the trend is down, right, for the markets, for some commodities. And so they shift in that way. And then when the market reverses, they're caught on what we say the wrong side of the market. The hedge funds were caught on the wrong side, being so short, even some fund managers. So it just caught a lot of people off guard if they had changed their and really they had reasons. There was thoughts out there that worst case, what's happening in Iran could spark a global recession because of the oil price spiking, the supply disruption. I mean, we still have a gap between, now that more and more tankers, more and more cargo ships are moving, there's still going to be a gap, in some of those supply chains. But the picture has literally changed. It seemed like 180 degrees overnight with Iran controlling the Strait of Hormuz, locking it up, to the U.S. Navy taking over control of the Strait of Hormuz, and ships are moving, except for Iran. But those cargo ships and tankers are moving now. So it's just been a very quick change, and so that caught a lot of people. It caught a lot of these entities off guard, and so now they're scrambling, people scrambling to take off their hedges to re-engage the market, who didn't just who weren't already there or had bought the dip or had just stayed with their portfolios through this brief downturn. What's turned out to be a brief downturn compared to what we thought it could be, which could have gone on for months.
Okay, so as we've seen stocks kind of melt up, we're also seeing the dollar reverse course as well. It had been declining quite a bit, an 8-day losing streak before moving just slightly higher today. What are you looking for in terms of how that now, in general, the weaker dollar of the last couple of days, what does that mean for commodities, which are priced in dollars? Because gold has not been the beneficiary of haven demand the way that many people might have thought it would be.
Yeah, that's a good point, Scarlett. We had, as we came into the year, commodities doing extremely well, gold and silver, other metals, the miners doing very well, stocks, doing pretty good. And we had a dollar that's been weakening, and so, or has been weakening. And when we had the issue with the Iran conflict, we saw strength in the dollar. And when we saw the dollar strengthening, things that are priced in the dollar, like gold, silver, foreign investments, emerging markets, all these areas, and that's the key, all these areas that got hurt so bad over that month are now exactly the places you want to be because the dollar is weakening. Commodity exporting emerging markets
Yep.
are looking better. So in terms of that dynamic, when we invest overseas or things that are priced in the dollar now weakening again is good for those areas.
David, thanks so much. As always, appreciate getting a few minutes of your time. David Kudla, founder, Chief Executive Officer, and Chief Investment Strategist at Mainstay Capital Management, Troy, Michigan, via